Today we're going to be talking about self-directed IRAs and how they invest in real estate on a broad scale. We'll also talk a little bit specifically about syndications, which Matt and I were just chatting about. And the idea is to give you enough knowledge of this tool that hopefully you can implement it in terms of your real estate investing strategy. And certainly, you know, I'm happy to be a resource, an ongoing resource for any ideas that you have or information that you need. But the idea is to give you a sense of really what self-directed IRAs do, what they can and can't do, and how you might be able to utilize them.
And Clay, why don't you give a little bit of an introduction? I should have started off with that. I apologize, but just so that everybody knows who you are, what your background is, you know, and just kind of the Cliff Notes version.
Sure. So my name is Clay Malcolm, and I work for Advanta IRA. We're a self-directed IRA provider. I've been in the industry for about 10 years, and I am a self-directed IRA real estate investor myself, as well as a real estate investor outside my IRA. So I have a vested interest and a real interest in real estate investment. And like I say, I've been in the self-directed IRA space for about 10 years, mostly as an educator. It's a great tax tool and a great investment tool, but most people just don't know how it works or what it's about. And so one of the things that I really like about my job is that I get to kind of, you know, go to events like this and meet people like you guys and just talk about what it is and how it can be used. So that's really my story. I'll be perfectly frank with you. My retirement was not in good shape when I got into the business. And so the whole thing about, you know, being in the self-directed IRA industry and learning about more about real estate investing has been particularly good for my own retirement. So
how did you, if you don't mind me asking, how did you get into this space?
Yeah, well, it's very niche. And so the actual details of it, most of the time you're going to have to learn that. You would have to learn that in the industry. So my background is a lot of teaching and people management. And so both of those things were necessary for the company that I started with because it was growing, expanding a lot. And also, you know, so we needed somebody to do some of the people management. And also, as I mentioned, a lot of my job is education, and I had a lot of teaching experience. So what I brought was those kind of natural experiences, and then learned the details of it kind of as I went.
Cool. All right, let's dive in.
All right, sure. Well, first and foremost, I'll just say that, you know, all the information I'm going to give you today is for education purposes only. At Advanta IRA, we don't give tax, legal, or investment advice. We don't advocate any particular investment strategy or investment vendor. And we certainly encourage you to do your due diligence anytime that you are considering an investment for your self-directed IRA or for your personal funds as well. And one of the things that I usually say when I talk about the disclaimer, and Matt and I were talking about this a little bit earlier, you know, at Advanta and any self-directed IRA provider that you might choose or have, we're a relatively neutral part of the equation. I mentioned that we don't give tax, legal, or investment advice. Our job is to do the administration and the bookkeeping for the account so that you get to keep the tax advantages. So we're not here to tell you what to invest in or what the price point is or any of that kind of thing. So the strategy part, as you'll see in the presentation, really lies with you and your team. Self-directed IRAs are a little bit of a paradigm shift for some people in terms of their tax-advantaged accounts because it really does shift some of the motive force that has to occur. So the decision-making and the due diligence all become part of what the account holder does instead of having an advisor or a robo-advisor or something like that do that kind of decision-making for you. So it really is taking control on a personal level of what the investments that your IRA is going to invest in. So just to give you a sense of what a self-directed IRA provider does, it's really, our job is to listen to what you want to invest in, help you to do that, help your IRA to do that, and then make sure that the account stays in good standing. So
who does do the advising then? Is that more of a financial advisor? Because what I'm hearing you say is you pretty much administer, you know, you can answer questions and you administer the account. Who does give the advice?
Well, everybody brings their own team, right? So some people have a CFP, CPA, lawyer. For some people, their advising team is their family, so parents or kids or things like that. Lots of people, a very common strategy is for somebody to bring their real estate team with them. right? So I have a house that I bought for myself, or I have an investment house already, and I'd like to do that same procedure and have it be inside my IRA. So they really they bring their existing real estate team and their existing financial team with them to perform the due diligence, decide on the asset, negotiate the deals, all that kind of stuff. So it's one of the benefits, I think, of self-directed IRA investing, is that you're not being forced into a team that you don't know, or somebody else's team. You get to bring your own.
So, and this is just a way to fund the transaction, just to be clear on what a self-directed IRA is. Maybe I'm getting ahead of you.
Well, you probably just looked at the slide there. So the idea is really this, is that an IRA, whether it's a traditional or a Roth, and there are other account types that are available as well, it does not have to invest in stocks and bonds and mutual funds, right? So in the 1970s, when IRAs were created, you have, ever since then, you've always had the ability to have your IRA buy things like real estate or precious metals or make loans in your IRA, and have those investment returns have the tax advantages of the account. So you're actually, the main idea of what we're talking about today is attaching the tax benefits of the account type with the returns that you can make on real estate. So instead of you making contributions to your traditional Roth IRA or your 401k and having that money buy a stock, and hopefully your account is growing by either the stock appreciating or stock dividends or something like that, instead of it being a stock, it's a piece of property or a syndication or a loan. So in the case of property, it is that IRA, either the traditional or the Roth or whatever account type, and it buys a piece of property. So the way that your account grows is either if that property appreciates and or that property produces rent. That entire financial sequence of your IRA, buying the property, receiving the rent, and then maybe eventually selling it, all of that occurs within the tax umbrella of the account type. And what that means is that the returns are tax deferred.
Explain what that means. So there might be somebody that rewatches this recording that doesn't even know what an IRA is. So an IRA is an individual retirement account, right? And the premise is that you can put money into an IRA and there is a tax advantage of some sort. Correct? Am I getting that right?
That's exactly right. So it started in the 1970s as a way, companies were offering less pensions, as a way to help people with Social Security. So the government established this system of these individual retirement arrangements. And what it is a way for an individual, a person, to save money with some tax advantages so that you get to save more or accrue more for your retirement, right? And so the general sequence of events is you make contributions according to the rules. So the IRS has some rules about what you can contribute and how that works. Once the money is in the account, it's going to buy some investments. So it could be stocks or real estate or any of those things. And when those investments produce returns, instead of that return being taxed and then you being able to reinvest the rest of it, the return comes back and it's not taxed. It's still in the account, but it's not taxed. So a really rough example would be, hey, my IRA bought a condo somewhere for $100,000, and then a couple of years later I sold it, and my IRA sold it for $120,000. Right. So the earnings of $20,000, if it were in my personal finances, that $20,000 would get taxed. And so I would
capital
not.
Gains.
I'm sorry?
Capital gains tax, right?
Right.
Yeah.
Assuming it's over a year. Yes. Capital gains. So I would have less money to reinvest, right? It would be some fraction of that amount. In an IRA, if the IRA does that same sequence, the entire $120,000 comes back into the account and can be redeployed or reinvested in its entirety. And the reason that that's important is because over time, the returns not being chipped away each time means that the money can compound faster. And so this is the same dynamic as you have, whether you know it or not, in probably your company 401k or your company's retirement account, whatever 403B or 457 or whatever it is. That,
let me ask you, Clay, it's taxed eventually, right? So how, and, I don't want to get too far ahead or too far off track, but how is the tax eventually calculated and when?
Yeah, it's a great question. And there's actually two different scenarios for that. So traditional IRAs, which were the first ones, they were created in the 70s. Roth IRAs came around later, it was in the 90s. So the tax event is different. So let me run through both of them. In a traditional IRA tax strategy, which is also the same one as most 401ks or thrift savings plans or other retirement accounts, almost all of them have this same tax strategy. And what it is this: when you make a contribution in a given tax year, you get a deduction for that, right? So it's quote unquote pre-tax money in, because you got to take it off of your taxes. So you got a tax deduction for it. So it's pre-tax money in. While it's in the account, as I mentioned, it can invest, create earnings, and those earnings are tax deferred. So they get to keep growing and compound faster. In a traditional IRA, when you take distributions, again, assuming it's over the age of 59 and a half, which is a threshold age for the distributions, then whatever the amount that you take as a distribution in any given year, that gets added to your income at that time.
Okay.
So whatever your income tax rate at that time is the rate that it will be taxed at which it will be taxed.
Interesting. So all the transactions that you might do with that money, none of that capital gain, that you never really get taxed on any of that.
Correct.
Okay. Mike DeVilla has a quick question, Clay. I'm sorry to take you off your presentation, but I like these free-flowing conversations. I think they're more interesting. Yeah. He asked, with stocks, you can buy a few shares. How do you buy a percentage of a $100,000 house if you only had $10,000 to contribute?
So that's a great question. So there are a number of ways for a particular dollar amount to participate. So if your IRA has the entire amount, obviously you can buy it. If your IRA does not have the entire amount, there's a few things you can do. One is you can partner with other investors. So that can be a syndication, which is, as Matt and I were talking, it's really just a collection of investors pooling their money to go and buy an asset that none of them individually can afford. Or you could all be tenants in common on a property or something like that. So the entity, it could be just tenants in common of each individual investor, or you could all be collected into an LLC or an LP or some sort of thing like that, where it collects the investors and you become one entity that buys the real estate. The other thing is that IRAs can actually take out debt. And this is a surprising thing to most people, is that the IRS will let us as IRA holders borrow money. Our IRA can borrow money from a lender to extend our buying power. So if my IRA doesn't have the full purchase price of a piece of property, it can actually borrow the money and secure the property. Now, my IRA does have to, like any borrower, has to pay the debt service. But the fantastic thing about it, or that it seems fantastic to me because it seems like the IRS wouldn't let us do this, is that the entire proceeds, all of the revenue that's generated by that property, goes back into your IRA. Even though it's borrowed money. Even though it's borrowed money. Now, I will say that there's a caveat there, which is something called unrelated business income tax, which can come into play. It's a little bit longer and more sophisticated topic than we're going to get into today, but understand that it does exist. But the general premise of this idea is that your IRA can borrow money if it doesn't have the full purchase price. So you do have a few options if your cash balance is below what you would need to get the property. Okay. All right. Okay, cool. Let's proceed. Okay. Well, let me go back to the other question too about the tax benefits, and because I do want to contrast traditional IRA with Roth IRA. Okay. So a little later, a couple of decades later, after traditional IRAs were created, a Roth IRA was created, and it is also a tax advantaged IRA, but it flips the script when it comes to when the tax event is. So as you remember, when we make a contribution to a traditional IRA, it's pre-tax money, meaning that we get a deduction for it. For the Roth, you do not. So you get your paycheck, it's already had your Social Security and your taxes deducted from it, And from that money, you make your Roth contribution. You do not get a deduction for it. While that money is in there, it is tax deferred as well. So it gets to create earnings that are tax deferred. However, in a Roth, assuming that you take a qualified distribution, again, later on in life, there's no tax on the distribution, meaning that you pay all of the tax freight, so to speak, up front, and then you take that out of play. So a Roth IRA, in some cases, can really be a very powerful tax tool, especially if you're looking for tax-free income when you're retired. So imagine this, your Roth IRA buys, and I'm just going to use an easy example, a single family rental, and it uses debt, but it pays off the debt over time. And then so the debt goes away. And let's say at age 62, I'm going to retire and I would like to start getting some income from my IRA, from my Roth IRA. I can start taking distributions at whatever level I want, and it's tax-free because I paid the tax at the beginning. And so literally that property that has renters and tenants in it can be the tenants, the renters, they send the rent into my IRA custodian at Advanta, and it stays in my IRA's cash position. But I could set myself up on a distribution schedule of quarterly or annually or whatever it is that I want to do. So I literally could be taking that rent tax-free from the property that my Roth IRA owns and have that be a stream of income for me in retirement for years or even decades.
So let me understand that. I want to unpack that for a second. So what you're saying is I start a Roth IRA, I make contributions into the Roth IRA, and I'm taxed on that when I make the contributions. But then if I take that account to purchase a property, I can collect income from that property for over a period of time. And let's say it doubles or triples or quadruples in size, I can then deduct that and not be taxed at all. Is that what you're saying?
Well, it's not actually a deduction. So
or you're saying to take, what's the terminology?
Well, you take a distribution.
Distribution.
So you're taking value or cash out of your IRA and putting it into your personal financial world. The nice thing about it from the perspective of the taxes is that it's you don't pay tax on that distribution. Whereas if it were in a traditional IRA, when you take the money out, it is taxed.
Okay.
So that's the contrast in terms of the two tax strategies. Neither of them are necessarily inherently better than the other, but under certain circumstances, one may perform better than the other. So it's a good thing to talk to your CPA or your tax person about, because there are a number of factors to analyze there. But yeah.
Great.
Okay. So now let's talk about the self-directed part. So typically that terminology, understand this, self-directed is just a descriptive term. It's not an account type. And really what it usually refers to is that the account holder is going to have a choice in what that money buys. So we talked about the fact that your IRA contributions, and over years, that's several years of contributions usually, what is it going to buy? Well, it's going to buy some investments. And so that the choice of what it is that your IRA is going to make, if it's self-directed, it's up to the account holder. And so at a bank or brokerage house IRA like Schwab or Fidelity, they'll say, well, you have a choice between these 10 mutual funds and these 20 stocks or whatever it is. At a custodian like Advanta, where we handle alternative assets or real estate and other private assets, it can mean buying real estate, buying gold, making a loan, private equity, and syndications was kind of the theme that we started out with this presentation, because it's one of the real estate investment tools that's very popular right now. So usually when somebody says self-directed, the truth of it is it means that the account holder is going to have some choice. And to be even more specific about it, if you have a self-directed IRA at a custodian or an IRA provider that handles alternative assets, that means that your IRA, instead of just purchasing stock, can purchase real estate or any of the other things, cryptocurrency, any of the other things that we started to talk about. So that's really what we're talking about when we're talking about self-directed IRAs. The interesting thing is that the IRS does not say to IRA providers like Advanta and Schwab and Fidelity, it doesn't say to us you have to handle everything that's legal. the IRA provider or custodian actually gets to choose which assets they handle. And so the thing that's important about that for you as an IRA holder is you want to have your IRA at a custodian or a provider that handles the assets that you want that money to invest in. And do understand that you can have multiple IRAs operating simultaneously. That's totally fine. I went a little crazy because I'm in the business, I think, and I have 8 or 9, I think. So, and you can move the money in between those accounts, usually without tax and without penalty, right? So you get to put them at the custodian that handles the asset that you want to invest in.
Okay.
Yeah.
Great.
Okay. So that's really what we're talking about when we talk about self-directed IRAs. It's not a different account type. And in fact, I'm going to skip through two things here and go to the account types. I'll come back to those other slides. The account types actually stay exactly the same as the ones that you are familiar with. So it's a traditional IRA or a Roth IRA, like we talked about. Both tax tools, slightly different in terms of when the tax event occurs. A lot of people don't know that their health savings account can also invest in real estate and other alternative investments. So if you have an HSA, that's a great tax tool as well. And then there are some employer opportunities as well. So there's a SEP IRA and a simple IRA, both of which are employer plans. And one of the most common things, and I would say it's most common generically, is somebody will have a 401k at a company where they no longer work. And one of the things that means is that 401k money can be rolled over without tax and without penalty into an IRA. Usually it's a traditional IRA, but in some cases, depending upon the 401k plan, it could be a Roth. So a very common strategy that we see for folks who want to use their IRA money to invest in real estate is they'll open an account with us, and then they'll do a rollover from a 401k at a previous employer or a couple of them, and they'll use all of that money. There's no limit on how much you can roll over, and then they'll have a relatively large cash balance, and then they will go out and invest in real estate. And again, that could be a physical property, or syndication, or a partnership, or some debt instrument, any of those types of things. But the
How
thing
long
that
does it take, Clay? I mean, let's just pretend that I had, I don't know, $200,000 in an IRA, self-directed. Well, then I wanted to purchase a property. What is the process to utilize those funds, and how long does it take?
Well, you can actually get an account open with us and have the funding of an investment occur in as fast as 7 days.
Okay.
It often takes a few weeks, but 7 days is the fastest. And so the process is this. You open an account with us. We get the account open in a business day. The application takes 10 or 15 minutes. It's not a big deal.
Mm-hmm.
Then we look at the other accounts that you have and decide what you're going to move over. So whether it's a rollover from an old 401k, or you already have an IRA or two and you want to do transfers from those. Transfers are also not taxed and not penalized. So what you've done is establish an account at a custodian that handles real estate. You've put some money into that account via rollover or transfer, and you can also do contributions. So now that account has the tax advantages attached to that money, and it's sitting there waiting to be deployed. And so you, as the account holder, you call up your real estate team, and frankly, this often happens before the account gets set up. You're looking for investment properties or investment opportunities. And the way that and it is going to be the IRA that actually does this. And one of the key things to remember about IRAs is that an IRA is actually a legal and financial entity that is separate from you as the account holder. Okay. And what I mean by that is, I'm Clay Malcolm, and I have a certain amount of dollars in a bank, right? So that's my personal financial world. When I make a contribution to my IRA, IRAs are a little trust, right? And that's why you have to have a custodian, and there's a couple other reasons as well. But when I make a contribution, it becomes separate from me, even though I'm the decision maker. And the reason it's becoming separate from me is because it's going to get tax advantages that I don't get personally. So the IRS is tracking this chunk of money that I've now contributed to either my IRA or my 401k or whatever the account type is. So And these IRAs, it has a different name than me personally, has different bank accounts, and it actually operates under a different tax ID number, not my social security number. So you can think of it almost as a remote control investor. So you're putting some money over with this remote control investor. You are controlling what it does. You decide what it buys, when to sell, what the price is, all those things. You're in control of it. But it does operate at arm's length and kind of separately from your personal finances.
Does the custodian, are there any circumstances under which you would not be able to buy a property? I mean, the custodian, what I'm hearing you say is the custodian is just making sure that you're abiding by whatever the rules the IRS sets up. Do they have any say whatsoever in how the money is used?
Well, the custodian will not have any say in how the money is used, but there are IRS rules. So I appreciate you bringing that up, because they do impact us, right? So there's a set of persons called disqualified persons that the IRS dictates to all of us IRA holders. And the set of people that is disqualified is me as the account holder, my spouse, ascendants and descendants, and the descendant spouses. So my spouse, my parents, my grandparents, my kids, my grandkids, and their spouses. That set, that lineal ascendancy and descendancy, those people have some restrictions in the way that they interact with my IRA's investments.
So you're saying I can't buy my mother's house with the IRA necessarily?
That's what I'm saying. Yes.
Okay.
Yes. So, and one of the most common questions I get, and I actually see it here on the chat, is that if I already personally own a property, is there a way for me to get it into my IRA to get the tax advantages attached to it? And the answer is no.
Well, somebody asked that in the chat. Did you see that? Okay.
Yeah, I did.
Sorry, Michael.
Yes, I'm sorry as well, because it's something that I would have done as well. But so that set of people does have some restrictions, and it's not just buy and sell. It's also credit arrangements. So as I mentioned before, an IRA can be a lender. My IRA cannot loan to me personally or my parents or kids or things like that. Now, I do want to stress also that disqualified persons is not all family members. My siblings and my cousins and aunts and uncles, they are not disqualified. So if my IRA wanted to buy a rental house that they had, it could, or make a loan or any of those things. So it's just.
This might be a really stupid question, Clay, but it just occurred to me. Okay, so you're buying a house and it's a stranger, right? You don't know, it's an arm's length transaction. You have no idea who the owner is. You're putting title in your name, right? Or is it in the name of the IRA?
Exactly. It's in the name of the IRA.
Okay.
Right. And so we were talking about, how does the IRS know that this is in the IRA? And one of the reasons and the ways that they do that is the title holder is actually the IRA. And the naming convention is this. It's usually the custodian's name first, so Advance IRA, and then FBO, which is for benefit of, and then Clay Malcolm, and then usually it's comma IRA, and then they'll put my account number on there. And so on every single piece of paperwork, from the offer to the closing docs to the contract with the property manager, if my IRA hires one, to the sale documents well down the line, all of those documents have that name, the IRA's name, on them, not my personal name.
Who's executing the documents?
Right. So as I mentioned, an IRA is a little trust, and so actually we, as the custodian, are the signers for your IRA, or for my IRA, and all of our account holders. So the signing sequence adds another person. And so what that means is, let's say the closing documents get generated. The first thing they would do, those closing documents would go to the IRA holder, the account holder, and they would look through them, make sure it's what they wanted, and then they would write read and approved and sign it, but in the margins, not as the buyer. This read and approved is an indication to us as the custodian of the account that this is the investment that you want and that you've reviewed it and it's exactly what you want. Wow. Then it comes to us and we sign it on behalf of your IRA. So again, another way that the IRS recognizes this account as being separate from your personal finances. And let's continue the process here. So all of the money that is being dispersed is actually coming out of your IRA's cash position to the title company or to the closing. If you're using debt, then part of the money obviously comes from the lender as well. And then when the renters move into the property, and again, we're just using the single family rental as a paradigm, but it's not the only thing you can do. Then the renters actually pay the rent into the IRA's cash position. So as the account holder, what I look up is I look on my online portal and I see, oh yes, the renters have paid the rent, and that IRA cash position has to handle all of the things that you would normally as a real estate investor. So the IRA pays for insurance, it pays for maintenance, taxes, anything that the investor wants to have taken care of for the property is actually handled out of that IRA's cash position. So it's a little bit of a closed financial system. And again, it's the account holder that is dictating every one of those moves. But it's all occurring under the auspices of the IRA so that you get to keep the tax advantages.
So if the IRA is the title holder, the IRA is the landlord on a lease, right? What happens if you have to evict?
Well, then your IRA needs to pay somebody for some legal help to get somebody to evict the person.
So, but you're the account holder is directing all of that, right?
That's correct.
Okay. All right.
And also making the determination of all these things. One of the things I find when I talk to people, especially as they're investigating this the first time, is they feel like once they make the initial decisions that everything is locked in, and that's not the case. So if you as the IRA holder want to change the rent on your IRA owned property, you can.
Yeah.
And that can either be because rents are going up and you want to go up, or let's say you have a vacancy and you just want to get it filled. Well, you can lower the rent a little bit. You get to make all of those strategic decisions for your IRA just the same way you would as a real estate investor outside of your IRA.
Okay.
Make sense?
The other question that I had is, which was fascinating that you brought up that the IRA can borrow money. How does the lender qualify how much you can borrow?
That's a great question.
Your personal income?
Yeah, well, it's an interesting thing because, again, this is the IRA that is borrowing the money, not you personally.
Right.
And one of the things that the IRS stipulates is that when your IRA is borrowing money, you personally, as the account holder, cannot attach your personal assets to the loan. So there's no personal guarantees. So when my IRA took out a loan, and my IRA has done this, when it takes out a loan, it has to be non-recourse, meaning that if there is default, the lender cannot come back to me personally and take my house or my car or any of that kind of stuff, because I never pledged that as collateral. So the qualification of the loan is usually based entirely on the property. And what that means from a lending standpoint, because it's non-recourse, the lender can't come after me personally. Usually they will want a higher amount down than I would get if I could make a personal guarantee. So instead of putting, 15 to 25% down or something like that, usually the lender will want 35 or 40% down.
But are they checking? And they can't really check credit, right? I suppose they could check quote unquote income by seeing, what increments you've been putting money into the IRA. Do they look at any of that, or is it just based off of the value of the property in case they would need to foreclose?
Well, it depends on the lender, because the IRS is not dictating any of this, and the IRS does not get involved in what interest rate you pay or what the loan to value is, none of that. So it's lender specific. But the thing that I've seen that's industry practice is the lender will want to know something about you as the account holder, because you're the strategy maker. So it's very common for the lender to still run a credit report on you and look at your finances and that kind of thing. They don't have anything to do with the loan necessarily, but what they're really doing is kind of checking you out personally to make sure that you're a good bet, even though it's your IRA that is the entity that is taking out the loan. And when they set the terms for it, usually it's very property specific. They will think, okay, well, if the IRA doesn't, goes into default on this loan, how can I make myself whole easily with this property? So that's why the larger down payment.
Okay, understood.
Make sense? Okay. So one of the things that I have up on the screen here right now is just, so we talked about on this last slide, these are the account types. So this is the account types dictate the contribution rules and the tax advantages and the distribution rules. But this is a set of options in terms of investments that are all in the real estate sphere. So I keep using single family rental because it's the one that most of us are most familiar with, but it can be residential or commercial real estate. You can do fix and flips inside an IRA. You can do buy and hold. It can be condos. It can be raw land. Matt and I were talking about, I own some timber in my IRA. So agriculture and timber is available. Mineral rights, multifamily properties, and multifamily syndication specifically is kind of what we started thinking about in terms of this presentation, because again, they're so popular these days. And what that really looks like for us as a custodian and for you as an account holder is pretty much a private equity investment or a private placement. So usually these syndications are set up as an LLC or a limited partnership or a partnership of some sort. And your IRA buys a percentage or an ownership stake in that entity that then goes out and buys either an apartment building or an office building or self-storage warehouse, any of that kind of stuff. So those syndications are something that has become, as I say, quite popular, and they're an investment that IRAs can make, and they can make it with a variety of levels of cash, right? So it does mean that your IRA doesn't necessarily have to be able to, doesn't have to have all the cash to buy an apartment building or a fourplex or a duplex. If you're buying into a syndication, you're just buying a percentage of that particular venture. There are other paper assets that an IRA can invest in as well that are real estate related. So there's trust deeds and tax liens and things like that, and debt instruments. It's very common for IRAs to either originate a loan, and one of the loans that I used to make was to a fix and flipper. So I knew a person did fix and flips. They often needed some amount of cash. It usually wasn't a lot, either as a bridge loan or as part of their money to secure the property and do the repairs. And so my IRA would loan them the money, usually short term, and then they would promise, 10% return or whatever it was. And then that money would come right back into my IRA, and then I could loan it out again. So debt instruments like that are available. And you can even buy you can buy existing loans as well. And you can buy them either fractionally or the whole loan. So I've certainly seen IRA holders that go out and buy non-performing notes or things like that. So again, almost anything that you know how to make money at outside of your IRA in terms of your real estate expertise or strategy, you can almost always make money at that same thing inside your IRA, as long as you take a little bit of time to set it up properly, so that you get to keep the tax advantages. But the IRS really allows you a pretty wide playing field when it comes to that particular choice. And then you also see on the screen here, with or without debt leverage. So the debt leverage is something that not everybody's comfortable with. And certainly when you're talking about IRAs, usually another factor that comes into it is your age, right? So if you're well below the age where you're going to start taking distributions, usually it's pretty common for your risk profile and your investment decisions to be slightly different than they would be if you're in your 50s or 60s or 70s, where your risk profile probably changes to something more conservative. You might be looking for more cash as opposed to appreciation, things like that. So one of the nice things, I think, from my perspective about a self-directed IRA with real estate, and real estate as kind of an asset class, is that there are a variety of ways to invest in real estate, and they all produce returns in a slightly different way, right? So you're able to invest in the thing that is going to produce the returns and have the timing that is good for you in terms of the rest of your financial world. So that's something I really like about it. I mentioned earlier that, again, we were talking about and so some of these slides, Matt got a little ahead of us because his mind went to just the right place. Again, remember that you can bring your own real estate and financial team with you and bring that to bear on the decisions that you make in your IRA, in your self-directed IRA. And we were talking a little bit earlier about ownership structures, and so I actually have a slide about it, and this is kind of what it is. So Often I see IRAs that'll buy a property outright if they can, or if that works in the rest of their financial world. But I also see a lot of debt leverage, and this comes into play in a lot of ways. Let's say that you happen to be in an area or have an opportunity to buy in an area that you feel like is going to really appreciate in the not too distant future. Well, sometimes then taking out as much debt leverage as you can to secure as many properties as you can, it would be the way to go in your IRA. And especially if you're in your 30s or 40s or something like that, you're not going to be taking distribution of this money, and so you can really, maximize the debt so that you, at the end of the day, which is after 59 and a half, so to speak, then you can have all those properties and your IRA owns them, and then you can decide what to do with those revenue streams. We talked about the fact that an IRA can be tenants in common. So one of the things that I want to put in your head in terms of options is your IRA can actually, I know that I talked about disqualified persons, but your IRA can actually partner with your personal money. So it is possible for me to have, say, I'm going to buy 123 Main Street. I could be personally, Clay could be 60% owner personally and 40% owned by my IRA. Now it does have to be pretty rigid. So once I set that percentage of ownership, every single disbursement for purchase and maintenance and insurance and taxes needs to be split 60-40, and all the returns need to be split 60-40. Right, so the IRS just sees two undivided percentage ownership, and there's no, because of the disqualified persons thing, that does mean that there's no buying each other out. So it is a little rigid, but you can deploy personal money alongside of IRA money in certain circumstances. And if you have more than one IRA, so let's say you have a traditional and a Roth and maybe an HSA, you could have all three of those account types be tenants in common on a single property. Right, so you get to make the decisions for all three accounts all at once. So there's lots of ways to do that. A lot of people will ask me about LLCs inside of IRAs. Are they required? Are they a good idea? So on and so forth. An LLC is a strategic choice that the account holder makes. You do not have to have one. Your IRA can buy a property outright in the name of the IRA. But if you want to have your IRA money invest in an LLC first, and then have an LLC buy the property, you can do that. And you could do that either for cash management purposes, or if you feel like the LLC will provide some liability protection or hide your identity, or whatever it is you want to do, the IRS will let you employ that strategy if you so choose. The other thing that I'll mention is that you might hear a term in the self-directed IRA world kicked around called checkbook control. And what that essentially means is an IRA creates an LLC that is what I'll just call a wholly owned subsidiary of your IRA. So it's all IRA money. It's a single member LLC. It's all IRA money. And the IRA holder names himself the manager of that LLC. So you actually are physically writing checks on IRA money. Now, if you do that, and that can be very convenient, and it's a strategy that some people do. If you do that, I want to stress a couple things. One is the IRS rules follow the money. So the fact that you have an LLC as a subset of your IRA does not mean that the rules from the IRS go away. So disqualified person and investment rules, they all follow that money. The second thing is that an LLC is a legal entity, and so you do have to do the bookkeeping for it, keep it up to date with the state, et cetera, et cetera. So there are some roles and responsibilities for checkbook control that you just want to check out ahead of time so they don't surprise you. But it can be a tool, especially for IRA real estate investors, that can, in some cases, make your cash management easier, and in some cases also, save you some IRA fees. So it's something to look into.
Great. Michael, I just wanted to let you know we've got about 5 minutes left, so I want to make sure that there's time for questions, just so that you can gauge yourself with the slides.
Okay. Well, I can run through these relatively quickly, and then we'll go to questions. So, and some of this we already talked about. So I mentioned the fact that an IRA is a legal and financial entity, has its own name, own bank accounts, and its own tax ID number. And so it will be the investor, whether the investor is buying a property or investing in a syndication or any of those things. And as I mentioned before, it is a kind of a closed financial system and it is operating as kind of a remote control investor that has separate tax advantages from you personally. I did want to specify also that, people will talk about this idea of where I don't have an IRA. Well, this is a rollover chart from the IRS website, and it shows the fact that you can move money around from accounts pretty liberally. So there's a lot of yeses on this chart. And if you have any questions, go to the IRS website or just contact me. I'm happy to answer any questions you have about moving money around. But it's a good idea to take stock or take an inventory of the tax advantage money that you have, so that you can decide, is this a time for me to deploy some of that into real estate and into a self-directed IRA? I do want to just specify this real quickly because it's a common source of confusion. Yes, there are limitations to how much you can put into an IRA in a given year. Those are contribution limits, but do not mistake that for earnings. The earnings that those contributions that are already in the account make, those are unlimited. Your IRA can make $1 million next year, and it doesn't affect your personal taxes at all. All of that occurred within your IRA. Unfortunately, if you make a bad investment, you could also lose $1 million, but that's the nature of making a good investment. But the earnings and the activity of the account, those are separate from your personal tax world in any particular year. And I mentioned the fact that it's a relatively easy process to get started. So you open an account, you fund it with a rollover, transfer, or contribution, or some combination of those. You talk to your financial and real estate team, you decide on an investment, and away you go. We do have some other events and things like that. This is my contact information in case you want to contact me directly. But that's really the sketch of what I was trying to, again, kind of give you a sense of, is how to understand this tool as a real estate investment tool and as a tax tool, and hopefully, have it make enough sense that you're able to engage that or try to look into it for your existing real estate investment strategies. And I'm happy to answer any questions that anybody has.
Guys, what questions? Sean, Zach, Mike? Any questions? So if I'm understanding,
I have an IRA, and it's coming. It's an AXA IRA. Would I be able to roll that into this kind of an IRA?
Yes. So
Most likely.
Yep. If it's whether it's traditional or Roth, all you would be doing is performing a custodian to custodian transfer, and you can do some of it or all of it. That's up to you. The amount is up to you, and there's no tax and no penalty. So you're just moving it to a different custodian to access different asset classes.
Do you have an office here where we can meet with you, or?
I'm actually in Atlanta, and Advanta
Okay.
is a national company. So no, I don't have one in Philly, if that's what you're asking.
Okay.
But you're
Michael,
welcome.
I'll send out all the contact information afterwards so that you can connect with Clay directly.
Okay. Yeah. Great.
I think this is fascinating. I admittedly knew nothing about this going into this conversation. I think I have a little bit of an idea of what it is. I've got to chuckle, Clay, how you refer to the IRA as if it's this little robot, but I guess that's kind of what it is. The one question that occurred to me, I'm guessing this is a little bit off topic, but if you have something like this set up, especially if it owns real estate, I'm guessing you should have a will or some sort of legal instrument that, what happens if I have an IRA and I have you may not know the answer to this because you're not an attorney, but if I were to pass away, does that IRA automatically go into the estate of the holder?
This is a really great question. I appreciate you bringing it up. So IRAs, generally speaking, as long as the IRA holder designates beneficiaries, it actually bypasses probate.
Oh, interesting.
And so you are able to designate primary and secondary or contingent beneficiaries. And when you pass away, then they go to the IRA, all of its contents, whether it's a rental house or cash or combination of those things, that all passes to the people that you've named as beneficiaries, and it does bypass probate. And the tax ramifications are the same as for distribution for them as it would be for you. So if it's a Roth, that means the beneficiaries are going to get some tax-free distribution possibly.
No estate tax. Okay.
No, but if it's a traditional IRA and you're the beneficiary, then there would be tax as you take distribution. Right. So, but it just follows the regular account taxation.
Okay.
Yep. And I'll just mention this slide because I put it up here, and so I'm sure that you have a varied kind of professional background in this. Just knowing about this knowledge base could help you in a number of ways. One is your own real estate deals. And this could be, if you're looking for partners for a deal that you're putting together, or you're looking for money, understand that when you talk to somebody, you could be talking to their personal money and their IRA money. Both of those are possibilities. If you're a real estate professional and an IRA holder comes to you and says, hey, I want you to help me find a rental house for my IRA, you get your same commission as you would for helping any other client. So we've definitely seen real estate professionals embrace serving IRA investors. And then obviously your retirement, that's kind of the obvious one that we've been talking about the whole time. So just understand that knowing this knowledge base kind of puts a few tumblers in motion, hopefully.
All right, well, Clay, I want to thank you for joining. We had a small group today, but this will, of course, be sent out to the entire Grid Philly list, along with your contact information. I really appreciate you preparing this. This has been really enlightening for me. I also wanted to thank Go City Mortgage, who is a Grid Philly sponsor. Ryan Harsh, who's not here today, is a great asset. His contact information will be in the follow-up email as well. So thanks so much, Clay. It was great partnering with you today. I hope everybody has a great day. And the next meeting will be, just put my calendar here, on Thursday, October 21st. I will send out information regarding that topic as well. Thanks, everybody.
Thank you, Matt.